earnings and more corporate commentary. Angel One is the next company on our radar, and it reported an operationally slightly weak quarter, you can say. The company's profitability was impacted by IPL expenses and higher employee costs. In fact, some ESOP costs as well that they had to take on board. We have Ambarish Kenghe, Group CEO at Angel One, joining in to give us an outlook on the business. Ambarish, great to have you. Thanks so much for being with us. You know, it's interesting. I was taking a look at all your parameters as well, and the market has gone through so much of regulatory change, right? So April, May, June, the average daily turnover is kind of hovering between 35 lakh to, in the good months, about 37, 30, almost touching 38 lakhs as well, or 37 to be tops. Your overall revenue has managed to grow 8%. But there's still a lot of chatter. There's some chatter in the market that there's more to come. Maybe they'll change the weekly options expiry timeline from weekly to fortnightly. So how do you sum up the performance and revenue growth in this environment? And do you expect more in terms of F&O regulation, particularly on the weekly expiry side?
Hi, good morning, Surabhi. Thanks for having me here on the show. I think, look, we had, a solid execution quarter. You mentioned 8% revenue growth. When you look on an adjusted or normalized EBITDA basis, we actually grew by 30%. On a normalized PAT basis, we grew 26% quarter over quarter. So solid execution quarter. We've given this guidance before also that I think we were bottoming out in Q4 last year, and this Q1 we are showing that there is clear growth there. In terms of what you mentioned about the macro, I think in the short term it's been a little bit of a perfect storm, right? As you know, you've got some of the, of course, regulatory changes, which I think in the long term are super helpful because it makes the ecosystem stronger. But of course, we had the tariff conversations, the Pakistan escalations, you had the sort of war in the Middle East. So all of those things, despite that, I think the market has been fairly resilient. In terms of what is coming next, I think it's kind of a fool's errand to try to predict that. I do think that the regulators have balanced it quite well. I think they're continuing to balance both the trust that the consumers have in the market, but also balancing the growth of the market and making sure that you got the right set of price discovery, you have the right set of instruments in there. So I think I don't want to sort of predict what the regulator would do next, but all the conversations that I'm seeing, I think they're being very balanced about how they think about the retail investors as well as the markets overall.
So can you give us some, I don't want to speculate on this, but just to know, in case something like this does develop, if the product is changed from being a weekly product to a fortnightly product on the options side, to what extent can that impact your revenue and overall volumes?
It's hard to exactly predict how consumer behavior changes. I think that's like the holy grail in any case. But what I can tell you is that, look, if you look at our earnings, about 45% of our revenues came from F&O broking. So while people may think it's a very large amount, people think it was probably even larger, but it's really only 45% that's coming from F&O. In terms of fortnightly expiries and changes like that, I think it all depends on the nature of it and how it is implemented and executed. But I don't think there is any indication from the regulators. So I think there's a lot of chatter, but I haven't seen any specific indication from the regulators. So my suggestion would be, I think we should just wait and see what happens there.
Right. Ambarish, hi, morning. Prashant here. Now we're talking about the numbers for April to June, right? But early July, we got SEBI, which came out with that order on Jane Street. Now, I don't want to talk about a specific entity, of course, but they were such an outsized contributor to volumes, etc. And a lot of people are saying, well, volumes are down since then. And maybe they are because, of course, what they were doing, but also because of others doing what they're seeing in the market, and that what was happening in the market was being caused by this one entity. So, participants had to adjust their positions in response to what was happening in the market, which was in turn being caused by this one entity. So volumes are down. Can you give us a sense since then? Because this is, we'll get a real sense of what's going on, since that order.
Hey, Prashant, good morning. I think anything like this does create a little bit of a shock in the system. Again, and it's a large player we are talking about. And a sort of a very significant order that was passed. in the short term, I think you always see, you always see certain good things happen. You see exuberance, in the short term, when something like this happens, there is a bit of a shock to the system. What I can personally see is actually there's been some recovery since then from, we of course will publish, we are probably the only entity who publishes our numbers at the end of the month. You'll see orders and everything come out. I do see some recovery from that. I think markets are not dependent on just one entity. I think there is a lot of, of course, there is, FPIs making investment, but you see a lot of DII.
Ambarish, if just to get a sense, and you said, I mean, we're almost at the end of the month, so maybe I'm asking you to give out the numbers before you publish them. But to the extent that you can, say from a baseline of 100, where are we now post the Jain order?
Look, I don't want to.
Are we at 80? Are we at 70?
Pressure.
Where are we?
I wish I could give you those numbers. I don't want to sort of jump the gun because I think it ends up, things end up changing across the month. There are different sort of ups and downs that you do see during the month. I do think, you see the sort of markets recovering. You're seeing some of the things recovering. I can't comment on exactly like what percentage impact these things have. That's hard for me to say. And we don't worry about day to day as much. I think we really have to worry about the fact that and celebrate the fact that, see, overall macro fundamentals haven't changed. Like when you look at the next 3 to 5 years, nothing has changed. I think India's GDP is growing phenomenally well. The demographic dividend is in place. How you see retail investors have grown both in derivative participation as well as overall equity. Like you see overall equity, right, over the last 5 years, I think investment in equities has gone from like 16 lakh crore to like 70 lakh crores. So that is continuing to happen. So I wouldn't worry about sort of the daily or monthly gyrations. That's, that sometimes ends up giving the wrong perception.
All right. Hi, Ambarish. Good to see you in. Nigel on this side. Let's get a couple of numbers, though. You've taken us through the macro, some parts of the micro as well. Let's focus on margins first. It mistreated expectations, right? Because of that 47% jump that we saw on a sequential basis in employee cost. Because of the stock options. You're also scaling new verticals, asset and wealth management and the likes. Given that, this employee cost has spiked up, it could be a little bit sticky, scaling into newer verticals. What is the outlook on margins on a blended basis for FY26? It's been declining for 3 straight quarters, so I ask you this question.
So Nigel, hi, good to see you. The way you have to look at it is that if you look at our earnings, you would look at some normalizations that we have done. So the last quarter looked, the employee costs looked a little bit lower because there was a one-time adjustment we had taken for variable pay. So therefore, you saw that, that's why you're seeing that kind of appearing as increasing. But once you adjust, the cost actually hasn't gone up as much. And if you look through earnings, it's almost sort of flat from Q4 to Q1. In terms of margins, if you adjust, if you look at the adjusted EBITDA margins, that would come out to 34% once you adjust for IPL costs and this employee costs that I talked about. So that's been sort of a healthy margin. We do think that margin will increase from here and in Q4 get closer to 40% margin. So that's something that we've given guidance on. At the same time, we are a big believer in long-term investments. Angel One, you guys are aware of it, but your viewers may not be as aware. But Angel One has been a company that's been around for 30 years, and actually in some form even more than 30 years. And we've been able to transform ourselves with all of these changes that have happened, and we've transformed ourselves into a sort of large technology company at this point. But you're also seeing us diversify. So if you look at wealth management, if you look at that AUM, that's grown very healthy. It's more than 5,000 crores now. On the AMC side, you saw that our AUM went up more than 340 crores. And it's very early days and it's growing well. On lending distribution, our lifetime so far was 700 crores. We added 230 crores more of that distribution, and you'll see that. So while we are transforming ourselves continuously into a technology company over a period of time, but you're also seeing us diversify. And all of these seeds, once you sow them, they're going to show you much more later on. And we look at it like a 3 to 5 years.
Okay. Absolutely. Sorry, Ambarish, so sorry cutting you short. Earnings seasons are just back to back. But very quickly, if you could just leave us with some numbers. One important number is you're saying your margins will get back to 40% by the fourth quarter of the current year. You're also investing in the wealth business and some of the other related businesses. So what is the total investment you've planned? And what should be a top-line expectation for FY26 full year?
So we don't talk about specific investments in those areas. We are not breaking it out right now. As we go along, we'll break that out. Same thing with the top line. I think it's very, very early investments right now, so we don't break them out. We broke out our revenue in terms of distribution, that's 3%. But wealth and AMC, it's still very early days, and it ends up being back-ended. You invest first, and you end up getting revenue.
You reap profits later. I mean, the wealth business, of course, is booming, has been booming. So we'll look forward to touching base later on. And, of course, look forward to the end of the month numbers, as you said, right, for that full month impact. Lack of Jane in the system. And what is the impact on orders. Ambarish, thank you very much. Good luck. Appreciate you coming on this morning here on CNBC TV 18 for that quick conversation.
Thank you very much. Really appreciate it.
All right.